Hello, very good morning to all and happy Friday. Very good morning. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Friday, the 7th of March, 2025. So before we kickstart the gist of today's Daily Dose, let's have a quick look as usual on the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's cover a very interesting intraday movement on the market yesterday in terms of the news flow, economic data release, and their impact on their respective intraday movement in those broad-based cross-asset classes ranging from the major FX, the major stock indices, and as well as the commodities market. Right, so let's start with the major US stock indices first. All right, so the major US stock indices continues to actually be rather weak, and that also came in within excuse me, pardon me, that also came in within our expectation for those who followed our daily dose of market insight, especially on the intraday technical segment, where we have been having this intraday bearish bias on the Nasdaq 100 and the US Wall Street 30, representing the Dow Jones Industrial Average since early this week, after that counter trend rebound has already more or less ended, where we highlighted on last Friday's daily dose over here. So I could see over here is that the worst hit was the Nasdaq 100. So we know that Nasdaq 100 itself is much more highly valued among all the major US stock indices, and also considered as a high beta index because it's centered on this very rich value AI driven productivity stocks. All right, over here. Okay, so what we could see over here at this point in time on the SPX is down by negative 1.8%. The Nasdaq 100 is down by negative 2.8%, whilst the Dow Jones Industrial Average is down by negative 0.9%. The Russell 2000 is down by negative 1.6%. And if you look at the heat map of the S&P 500 over here, very clearly those that are centered on the mega cap technology stocks, and especially on those AI high productivity driven play that has propped up the major US stock indices, especially the Nasdaq 100 outperformance against the rest of the world in the last 2 years got hit pretty badly yesterday. So Nvidia continues to bleed, down by negative 6% or so, almost to be precise, negative 5.74%. And he has a negative feedback loop into the entire semiconductor industry within the broader technology sector. All right, so what you could see over here is that the defensive continues to show some pockets of green yesterday, whereas healthcare, all right, there's some pockets of green in healthcare, and also your consumer defensive as well, which is considered as your consumer staples. All right, so those guys are actually outperforming yesterday in a broader risk-off scenario that has taken shape in the US stock market at this juncture. All right, so what's interesting over here in the FX space over here is that the euro, okay, give me a minute, let me open up the chart of the euro dollar. So the euro dollar yesterday managed to do a spike up during the ECB meeting. So after that spike up, it also hit our short-term intraday bullish buyers resistance level before ending in the red yesterday. So most importantly, the euro dollar also starts to form a kind of a bearish shooting star formation right below this 1.085/0.95 resistance zone, which is also parallel with the former major ascending trend line from the low of 3rd of October 2023, now turns into a pullback, a key pullback resistance support, and the price action reacted negatively to that right after ECB meeting. All right, so what ECB sounded meeting over here is that, let me share with you guys. Okay, so ECB has really starts to signal that the easing phase is about to end. All right, why? Because number one, ECB has been much more aggressive in cutting interest rates. So yesterday was their sixth cut to their key deposit rate over the sixth cut over here to bring it down to 2.5%. right? 2.5%. So the reason over here is that inflation has really cooled, and as well as the economy digest systematic shift in geopolitics situation. Okay, and also the reason why over here is that ECB signal this coming to a tail end of its interest rate cut cycle is because of the very strong fiscal spending plan that is being proposed by the new government of Germany, which is very, very aggressive. So what they want to do is that previously Germany eschewed to this fiscal austerity measures or fiscal discipline, but right now they want to move ahead with this fiscal discipline by having a wider budget deficit. So that wider budget deficit, if ECB were to continue hand in hand with cutting rates aggressively, that might ignite inflation pressure down the road in eurozone, right? So that's the reason why also ECB has really signaled that its easing cycle is about to end, because going forward, fiscal stimulus measure will now take a front load to boost the eurozone economy. All right, over here, and based on this result over here is that market now is now okay, because this is another scenario. So market now is looking at potentially two more quarter point reduction by year end. All right. So based on yesterday's, yes, despite it rose to a fresh all-time high, 4-month high, pardon me, the euro rose to a 4-month high, but at the end of the day, it ended rather not so rosy by this bearish shooting star, close to the retest of that 1.0885/094 resistance zone, okay, which I highlighted earlier on, which is the pullback of this former dotted major ascending trend line support now turns into a significant pullback resistance level. And if you do the Fibo retracement of that entire down move previously of that broad-based medium-term downtrend all the way from the high of September 2024 all the way down to January to 2025 low, that also correspond to the golden ratio of 61.8% Fibo retracement as well. Right, so something to bear in mind of. Later I'll touch on in the short-term intraday technical outlook. There could be some sign of a negative pullback or corrective pullback that euro dollar may take shape today. Okay, hope later I'll share more during the intraday technical outlook. All right, so this is how the price action react after ex-post ECB meeting. All right, so despite the fact that right, even though ECB has sounded to be less dovish over here, but their latest economic projection, so yesterday they also released the latest economic projection in terms of inflationary trend and growth trend in the eurozone in the next 3 years. So let me share with you what is the latest one right over here. So the latest economic trend, what we see on my screen, inflation excluding food and energy. So this is the exclude the volatile items that market participants tend to keep pay attention to. So the one in dark pink or bright pink is the latest forecast, March forecast. The one in black is the December forecast. So every 3 months there will be new forecast by ECB. So the one in March over here shows a slowdown in the inflation ex food and energy. By the end of 2025, it will go down to 2.2%, slightly below 2.3% that was earlier forecast in December, last December. But however, what you could see over here is that they expect inflation to actually come a slight increase to 2%, but that's within their target, the desired 2%, from the latest forecast for 2026, end of 26, slightly higher than 1.9% that was forecasted earlier in December. But if you look at GDP growth, right, across these 2 years in 2025 and in 2026, they actually forecast lower growth by 0.9% versus 1.1% that was forecasted earlier in December for the end of 2025. And by the end of 2026, lower growth as well by 2 basis points, 1.2% forecasted yesterday. That means the March forecast versus the earlier December 2025, 2024 forecast of 1.4%. So there is still a bit of what I call growth concern among the mindset of ECB officials. That's why they forecasted yesterday lower GDP growth versus their previous forecast released in December last year. So bear in mind with this thing over here, ECB Lagarde during the press conference, he actually kept option open in light of the elevated uncertainty from US tariffs and higher defense spending in Europe. So this higher defense spending is what I mentioned earlier on, that physical part of this physical bazooka that is being ignited in Germany or proposed by the new Germany leadership in parliament. And because of this elevated uncertainty in trade tariffs that could actually hamper GDP growth going forward in 2025-26. So based on her press conference, she did mention that she's keeping this optionality open. So even though she signaled a lower chance of a more dovish approach in ECB monetary policy, but things could change if GDP growth starts to slow down much more than their earlier expectation. So bear in mind over here is that it doesn't mean that the euro dollar will start to see a very clear spike up against the rest of the other currency, like against the dollar, because of this rather fluid situation that is taking shape right now in the macroeconomic space. Right, so this is something that I'll take note and highlight over here. Now back to Asia over here is that Asia, we now see a very star performer is previous 2-year laggards or 2-year underperformer, which is the China stock market and the Hong Kong stock indices, has now starts to shine very brightly this year. And also later I'll share the intermarket dynamics very clearly is now outperforming against the rest of the world. And yesterday we do have another sign of what I call we call it bullish rhetoric of more physical stimulus measure that potentially may announce this year by China top policymaker. So yesterday at 3 p.m. we have a press conference by the PBOC chairman, PBOC governor, and as well as the finance minister of China, where they actually hold this press briefing on the sideline of this ongoing week-long 2 session, which is the China key parliamentary session. So what the key meeting at 3 p.m. yesterday, the key highlights was that PBOC will choose timing this year to reduce rates further, both rates as well as the reserve ratio requirement of China major banks, and also plans to start up guidance funds to support big tech firms to sell bonds. So indirectly, the government is giving something like a collateral guarantee or something that allow startup firms as well as any China big tech firms with the likes of Alibaba to actually help to raise funds for to actually kickstart. Number one, two possibility, kickstart business expansion, and also possibility to hire more Chinese employees into these China big tech firms, given the fact that right now, like I mentioned earlier a day ago, the readout from Premier League work report that was released on Tuesday highlighted 27 times consumption, boosting consumption. This is the highest in a decade, a reversal from previously 20 over times that was mentioned last year work report, where the focus is on high-tech manufacturing, which is we're talking about factories or manufacturing. So that has been greatly reduced to only mention about 7 times in the work report that was released on Tuesday. So now clearly the top leadership focus is to boost consumer spending. And how do you boost consumer spending? You got to create more jobs. So very likelihood they are now getting the China big tech firms, which was a previously leadership in terms of boosting consumer confidence, boosting consumer spending, and hiring Chinese employees or workers in the previous 5 years before they got clamped down by the top leadership during the COVID period in time. So they're trying to reverse this policy to be more favorable towards China big tech firms, and perhaps this helping of selling of bonds by China big tech firms could be also a meaningful approach to actually allow them to raise funds so that they could actually use these funds to actually for business expansion or even to hire more Chinese employees. So net overall is to boost the overall consumer and business confidence in the Chinese economy to defeat this ongoing deflationary spiral in China. And also they did mention that right now they're trying to actually hold their cards by not revealing their cards pretty fully because of this ongoing US tariffs that is being targeted on the Chinese economy right now. So they said they'll respond in kind if US goes further on tariffs. And the key thing that this mentioned about this special campaign to boost consumption soon. So overall, that was pretty much in favor with the markets, where we start to see all the major Hang Seng indexes rallied yesterday. So if you look at the rally on the Hang Seng indexes yesterday, let me expand my screen. Okay, so this was stock index. Okay, so this was the Hang Seng Tech. Okay, so continuous of 3-day of rally. So yesterday it added 0.79%, and surpass above the previous peak of late 27th of February as well. Right, so very clearly a bullish momentum on the Hang Seng Tech, similar on the Hang Seng Index as well. Okay, added 4 day of consecutive rally. So yesterday is added in another 3.29%, right? 3.29%, and today price action continues to be positive as well. All right, try to be positive as well. So I repeat just now, pardon me, yesterday's rally on the Hang Seng Tech, where it's concentrated mostly on the China big tech, is up by 5%, 5.4%, because it's much more higher beta compared to the Hang Seng index, and also due to that promising of that China top policymaker setting up this guidance funds for China-related technology stocks and helping China technology-related stocks firms to actually raise bonds for their potential business expansion, or the funds could be used to hire employees over here for the Chinese economy. So, like I mentioned earlier, positive reaction of it. All right. So later I'll share with you what are the key levels to watch out for today on the Hong Kong 33, which is representing the Hang Seng Index in our platform. Right, and also these are the key news flow that taken shape yesterday, and also right now there is much more uncertainty surrounding this trade tariffs policy in US towards its major trading partner. So in a reversal yesterday, Trump mentioned again, he actually made an official announcement saying that certain products on Mexico and Canada trade deal will be delayed. Okay, still bearing that over here is this Tuesday they actually came into force. All right, this particular Tuesday where the 25% tariffs is being slapped on Canada and Mexico, which is on the 4th of March. And yesterday he made an announcement that under this particular North America trade pact, okay, because all three these countries are in this North America trade pact. So goods and services that's being announced in this North America trade pact will be exempted from the 25% tariff for a month. All right, so they will actually expire on April the 2nd based on this new directive from Trump. So it creates a lot of uncertainty about how Trump wants to actually dictate his trade tariffs policy, but that doesn't gel well to the major US stock indices. So I think the major US stock indices has starts to actually punish this uncertainty or this kind of fickle way of doing trade policy as being engaged or being enacted by the current US White House administration, where we start to see a very negative feedback loop that continue to play out in the major US stock indices. All right, so later I'll touch on more what are the key levels to watch out for today on the Nasdaq as well as the US Wall Street 30, representing the Dow Jones Industrial Average in our platform. And lastly, let me share with you what is the market expecting for the Fed funds interest rate trajectory cut or going forward. All right, so based on whatever we see so far, this taking shape this market in terms of geopolitical tension, monetary policy stances from other major developed banks, especially on ECB yesterday, so far market expectation based on the Fed funds futures trader as being compiled by the CME Fed Watch 2, market is still expecting close high chance of 91% that on the 19th of March, when the Fed meets, they will maintain status quo on the current Fed funds rate at 4.25% to 4.5% after 3 interest rate cut last year. So this 91% has been more or less the same. So a week ago it was about 96%. Now it dropped slightly to 91%, but still considered as a high chance. All right. So now going forward, right, into the next few meetings, all right, stretching in the next few meetings, what is the expectation that is being priced right now by the Fed funds futures traders as being calculated by the CME Fed Watch 2? What we could do is we go to this aggregated probability over here. So let me expand my screen, okay, so that you can see the table. Okay, so 91% chance maintain the same at 4.25% to 4.5%. So market now is assigning quite a higher probability on the June meeting, 18th of June meeting, a 68% chance that the Fed will engage in the 25 basis point cut potentially to bring down the Fed funds rate to 4% to 4.25%. All right, 50-50 chance, about 55% chance only on the May meeting, but higher chance on the June meeting, the 18th of June meeting. And also another potential 25 basis point cut on either to come in on the July meeting or the September meeting, because that is 57%, close to 60%. But the July meeting has a higher chance right now based on the latest Fed funds futures pricing as compiled by the CME Fed Watch 2. So market is looking at another chance of another 25 basis point cut in 30th of July. But what's interesting over here is that previously, since the before this we call it trade tariffs, we call it a policy that's being rolled out by the US administration, and the style of engaging and announcing such trade tariffs policy, but by doing this fickle-minded way of doing things. Previously, market only looking at two potential interest rate cut for this year, only two. But right now, there is a third interest rate cut has started to surface to come in either the 29th of October meeting this year and the 10th of December 2025 FOMC meeting, because there's a high chance of 75% and 89% chance for the Fed funds rate to be at 3.5% to 3.75% when the 29th of October meeting comes, and even when the 10th of December meetings comes. So potentially market is now implying three interest rate cuts of 25 basis point each before 2025 ends. So that also causes the dollar strength to remain under pressure because about this uncertainty surrounding this trade tariff policy on as conveyed by the current US White House administration. Potential tick for tat measures that could come into place for those targeted major trading partners, and that could potentially see a disruption in US economic growth, and that has been pretty much evidenced in some of the key US economic indicator, like the slowdown in US consumer confidence as being shown by the conference board, the S&P 500 so-called services PMI also shrink down to a contractionary mode. The ISM manufacturing prices, the ISM services prices input show a cost of doing business in the services industry or the services sector, and the manufacturing sector in US starts to escalate on the upside, and that could potentially translate to slower economic growth going forward because of the earnings growth that's being crammed down in these two key, especially on the services sector, which actually contribute to 3/4 of US economic growth. So that also saw the pricing of the Fed funds futures contract as being calculated by the CME Fed Watch 2 to actually right now highlight another third potential interest rate cut before 2025 ends, because of this potential slowdown in the economy, where the Fed got to be forced to cut. But this may change if inflation numbers, the data, those lagging one like CPI data, PCE data starts to tick up on the upside. That will be more like a stagflationary scenario already. So that could allow the CME Fed Watch 2 to revert back to even only two interest rate cuts or even one interest rate cut this year. All right, something to bear in mind for the longer term. All right, so now with that, now let me share with you two intermarket dynamics before we jump into the intraday technical outlook. Number one will be more pertaining to the US stock market over here. So like I mentioned, I did flash out before that the deterioration of this market breadth indicator by looking at the percentage of Nasdaq 100 component stocks above their 20-day moving average, above their 50-day moving average, and above their 200-day moving average, and also the other major benchmark, we call it US stock index, which is the S&P. Also looking at the percentage of S&P component stocks above their 20-day moving average, above their 50-day moving average, and above their 200-day moving average. So what I could see over here is that the percentage of Nasdaq stock holding above the 200-day moving average has plunged down to be around 50%. All right, around 50% now. Okay, now hitting the previous low of the start of the year. Right, so that is pretty negative in terms of market breadth deterioration. So we know that 200-day moving average is a pretty key moving average psychologically. If there is more stocks that are no more component stocks that are breaching below its 200-day moving average, actually signify a change of a medium-term trend towards the bearish side of the story. All right, so very similar on the S&P component stock as well. So this one already clearly breached below the 50% mark. So the percentage of S&P 500 stocks holding above the 200-day moving average now is at 47% based on yesterday's closing price of the S&P cash index, and it also breached below the earlier January low. Right, indicating a very deterioration market breadth on the S&P 500, given that the percentage of S&P component stocks is holding above the 200-day moving average is getting lesser and lesser, and is breached below previous swing low of significant low of 3rd of January, and now is below the 50% mark. So net overall, all this represents a deterioration in market breadth, and because 200-day moving average is a significant psychological technical indicator that most traders are watching, and it could create into a self-fulfilling prophecy, and this self-fulfilling prophecy will be a negative feedback loop, because there could be potential more bearish pressure on the S&P 500 and the Nasdaq 100 that could actually see a persistency in bearish trend from a multi-week perspective. All right, so this is the intermarket dynamics on share view pertaining to US market. But on the flip side, there's another intermarket dynamics on share view that is more pertaining to the Hang Seng Index and the China stock market. So using the ETF that is listed in the US, that means these are dollar dominated. So I compare a dollar dominated ETF versus the ETF that consists the entire world major stocks. All right, they call it the MSCI All Country World ETF, or ACWI. And this ACWI, I think close to what 70% are heavily concentrated, no, 60% if I'm not wrong, heavily concentrated in the US. All right, so if you look at the ratio of these three key China-centric ETF that is listed in the US Stock Exchange, the iShares China Large Cap, ticker code is called FXI, Invesco Golden Dragon China, ticker code PGJ, Crane Shares CSI China Internet. So this is the China big tech stocks, ticker code called KWEB, okay, KWEB. So I just divide all of them against the MSCI All Country World. So it's just basically looking at dollar dominated, two assets in dollar dominated China related stocks versus the rest of the world equity stocks, all in US dollar terms. All right, so if you look at the trend since 2022, this has been in a major downtrend now. The ratio has been a major downtrend. You look at the latest price action, all the three ratios has started to broken above their previous major downtrend line. Okay, over here, if you could actually look at one by one, all of them have broken above. So it seems to us that right now there is a change of relative strength on China related stocks against the rest of the world. That means China related stocks right now is now potentially picking up in terms of momentum, and that could potentially attract more inflows into such related China related stocks, which eventually could create a positive feedback loop back into the Hang Seng stock indices right now, given there is a change of the technical dynamic based on this relative strength intermarket analysis. And the momentum indicator has started to turn positive as well, by looking at the 20-week rolling momentum of these three respective ratios over here. So what you could see underneath is there's a rotation going on. That means, i.e., previously in the last 3 to 5 years, China stocks, Hong Kong benchmark stock indices has been underperforming against the US market and the rest of the world global equities. But right now, the tide has started to change, and China and Hong Kong stocks is now actually doing the start of a significant outperformance against the rest of the world and against the US stock indices. Okay, something that you got to take note of in the longer term perspective that I want to highlight, because this outperformance has just taken shape only, and this is a weekly chart, it's not an hourly chart, so it will tends to be more persistent in terms of the trend horizon that this outperformance may last of the China, potentially the China related stocks, Hang Seng benchmark indices against the rest of the world and against the US equity. Right, now with that, let us now focus on the intraday technical outlook on the FX market first. Wait, let me expand my screen so that you guys can have a better view of the chart. All right, so now let us start with the FX market over here. The euro dollar, so I mentioned that the euro dollar shaped a daily bearish shooting star. So what I could see over here is that it almost hit our resistance level yesterday at 1.0880. So, and also the RSI, the hourly RSI has started to shape a bearish divergence as well. So what I'm going to do is that I'll be using 1.0880. We'll flip to a intraday bearish bias for today, from a bullish bias yesterday, to potentially there could be an intraday bearish pullback scenario that could take shape. First support level to watch will be at 1.0730, which is also the 200-day moving average. A breakdown below 1.0730 potentially increase the odds of this intraday corrective pullback scenario to expose the next near-term support level at 1.0630. Only an hourly close and a push up above 1.0880 will invalidate today's intraday bearish bias for that potential corrective pullback scenario to see a squeeze up towards the next resistance level at 1.0940 / 1.0970, okay, which is the congestion area of 4th of December and 8th of December, and as well as the 76.4 Fibo retracement of that previous medium-term decline from September last year all the way down to early January this year. All right, so net in a nutshell, because due to the deterioration in technical elements on the euro dollar, both on the hourly daily chart and the hourly chart of this bearish divergence, we will flip to a intraday bearish bias for a potential corrective pullback sequence that may unfold using 1.0880 as my short-term pivotal resistance level. Onward next will be the sterling dollar. So the sterling dollar also starts to shape this bearish divergence on the hourly RSI yesterday. So it hit our first resistance level at 1.2910 before trading sideways throughout the entire US session. I'll be using 1.2965 as my short-term pivotal resistance level. We'll flip to an intraday bearish bias for a potential corrective pullback scenario that may unfold. First support level to watch will be at 1.2810, which will confluence very closely to the 200-day moving average. A breakdown below 1.2810 will increase the probability of this minor corrective pullback sequence on the intraday basis to expose the next near-term support level at 1.2750. Only an hourly close and a breakout above 1.2965 will invalidate this bearish view for today to see a squeeze up to revisit the next resistance zone at 1.3025/1.3040 next. So that's for the sterling dollar. Next up will be the Aussie dollar. So Aussie dollar, yesterday we flipped to a neutrality stance because of the mixed element, and upon the current technical elements right now has started to turn bearish on a intraday basis. Why? Because the hourly RSI has shaped a bearish divergence, and right now in today's Asia session, it also broken down a key parallel former minor ascending trendline support and breached below the 50 level. Hasn't hit the oversold region yet, so it represents some form of intraday bearish momentum has started to creep back into the Aussie dollar. So with that, yesterday's rejection off at the upper limit of our neutrality zone, which is 63.60, will now be turned into a short-term pivotal resistance level. We'll flip to an intraday bearish bias for some form of minor corrective pullback sequence that may unfold today. First support level to watch 63 figure, a breakdown below it exposes 62.60, which confluence with the 50-day moving average, acting as a similar support level as well. Only an hourly close above 63.60 level will invalidate today's intraday bearish bias to see a squeeze up to retest the medium-term pivotal resistance level at 64 figure on the Aussie dollar. Now, lastly, will be the dollar yen. So the dollar yen, what we could see over here is that it continues to plummet and hit our support level at 147.95, coming very close to the second support level at 14710/14690. So far, hourly RSI is not flashing any bearish divergence or bullish divergence, pardon me. Price action shape a lower low, hourly RSI also shape a lower low, and continues to trace out a series of higher low and being rejected by this parallel ascending trendline resistance below the 50 level mark. So with that, I will use a two resistance level to watch for today, and given that today is non-farm payroll, I don't want to tighten the pivotal resistance level to be too tight at 14840. So using 14840 as my first resistance level, 14920 my tighten short-term pivotal resistance level for today. So as long as any bounce didn't surpass above 14920 tighten short-term pivotal resistance level, we will still maintain the intraday bearish bias on the dollar yen. Below 14690, that will be my first support zone to watch. 14710, pardon me, 14690 will be my first support zone to watch. A breakdown below 14690 exposes 14650/25, which is the 0.764 Fibo extension. And if you go back over here, it will be the minor congestion area of 27th of September and 4th of October last year. All right, only a hourly close and a push up above 14920 short-term pivotal resistance will invalidate today's intraday bearish bias view to kickstart a minor corrective rebound sequence to potentially retest 150.95, which is so the downward sloping 20-day moving average. Above it, it sees a further extension towards 15165, which is the upper limit of the medium-term descending channel that is still in play since the swing high of 10th of January this year. So i.e. in a nutshell, still maintaining the bearish bias in any bounce as long as any bounce didn't surpass above the tighten 14920 short-term pivotal resistance for today on the dollar yen. All right, so that sum up the intraday technical outlook on the FX market. So now let us focus now on the intraday technical outlook on the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continue to burst up as expected over here. So right now, RSI still maintain rather a bullish scenario over here. As you could see, it continues to hold above this former If support swing high turns to pullback support and continues to shape a series of higher low. All right, so momentum still rather positive in terms of the intraday basis as depicted by the hourly RSI. So with that, price action now is coming close to the resistance zone that I highlighted yesterday, the upper limit 24,510. No signs of any bullish exhaustion as depicted by the hourly RSI. So I do not want to fit any counter trend, so there will be lower risk of any counter trend decline move on the intraday basis, and we will actually have a bullish bias to actually be along with this ongoing intraday bullish trend that is taking shape right now. So with a tighten key short-term pivotal support level for today, 23,830/600, this zone over here, we will maintain that intraday bullish bias for the Hong Kong 33 above 24,510, exposes the next resistance at 25,080, which is coming close to the upper limit of this ascending channel as well. That is in play since the low of 13th of January. Only hourly close and the breakdown below 23,830 or the 23,860 will invalidate today's intraday bullish bias to kickstart a minor corrective decline or a mean reversion decline heading back towards the rising 20-day moving average area here. First support level to watch 23,290 followed by 22,970. So i.e. in a nutshell, still maintaining the intraday bullish bias on the Hong Kong 33 for today, representing the Hang Seng Index using a tighten key short-term pivotal support zone at 23,830/23,600. Now, next up will be the Nikkei 225. So the Nikkei 225 continues to slide down as expected, broke below our first support level and did a retest on it at 37,130 as we are speaking right now in the last 2 hours. So with that, I will have a tighten key short-term pivotal resistance for today at 37,595, which is so this minor descending trend line that I drew from the swing high of 18th of February. So as long as any bounce didn't surpass above this tighten key short-term pivotal resistance at 37,595, we will still maintain the intraday bearish bias on the Japan 225, i.e. the Nikkei 225. Next support level to watch will be the swing low area of 4th of March that was being seen earlier this month at 36,450/220. Below it exposes 35,860 next. Only an hourly close above 37,595 and a breakout above it will invalidate today's intraday bearish bias to see a squeeze up towards the next near-term resistance level at 37,930. Above it sees an extension towards the 20-day moving average, acting as a similar resistance zone at 38,325/38,490. All right, so that's for the Japan 225. Onwards next will be the German 30 or the German DAX. So the German DAX continues to trade higher over here. The hourly RSI continues to hold above the 50 level mark over here at this point in time. So there was actually a test around the 23,300 level. All right, over here, it break around and test around it and almost hit the next resistance level at 23,600. So yesterday it printed a fresh intraday all-time high at 23,482, right? So with that, still no change, still using the 22,800 level in any chance of any pullback. First support level is 22,950, slightly below it is 22,800. So this is a zone. So 22,800 will still be my short-term pivotal support level in any potential minor pullback. As long as this level holds, 22,800 short-term pivotal support will maintain the intraday bullish bias for the German 30 to scale potentially fresh all-time high again. Next resistance level to watch 23,600 followed by 23,820 defined by a Fibo extension cluster. Also the upper limit of this ongoing ascending channel from the low of 13th of January. Only a hourly close and a breakdown below 22,800 short-term pivotal support will invalidate today's intraday bullish bias to kickstart a minor mean reversion decline scenario to revisit 22,400, which correspond to the lower limit of that ascending channel and also close to the rising 20-day moving average as well. All right, only a breakdown below 22,400, then that would see a deeper corrective decline sequence, exposing the next near-term support level at 22,120, which is the minor swing low area of 21st of February. So i.e. in a nutshell, still maintain that intraday bullish bias in any potential pullback, as long as this pullback didn't surpass below 22,800 short-term pivotal support on the German 30, i.e. the German DAX. So now let us now head towards the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average, and it's continued to shape that bearish reaction exactly off our short-term pivotal resistance zone at 42,980/43,120. So for sure, this is indeed a pivotal resistance level after that bearish reaction of it yesterday. Hourly RSI continues to be rather lackluster or bearish and continues to actually print lower high over here. So with that, we will still use 42,980/43,120 as my short-term pivotal resistance zone. Maintain that intraday bearish bias. First support level to watch 42,210. A breakdown below it. Have a test on the 200-day moving average at 41,980/41,770. Only an hourly close and a breakout above 43,120 will invalidate today's intraday bearish bias to see a squeeze up for a counter trend rebound scenario taking shape, revisiting 43,530. Above it sees 43,885. We also correspond to the downward sloping 20-day moving average. All right, so that's for the US Wall Street 30. Still maintaining the intraday bearish bias using 42,980/43,120 as my short-term pivotal resistance level. Lastly will be the Nasdaq 100. Nasdaq 100 continues to plummet and hit our first support level and almost coming close to the second support level is the 0.618 Fibo extension on the downside, 19,910/19,840 level. All right, so with that over here, the hourly RSI also continues to print a series of lower high and doesn't shape any bullish divergence yesterday. All right, lower low, lower low, similarly at the oversold level on the hourly RSI. So given that it's oversold, there could be some kind of bounce to retest the first resistance level at 20,340, which is the 200-day moving average that has been taken down yesterday. As long as it didn't surpass above our Titan short-term pivotal resistance for today, which was rejected on Wednesday and as well as on Thursday at 20,720. Okay, so using a Titan key short-term pivotal resistance at 20,730, still maintain the intraday bearish bias on the Nasdaq 100. Below 19,840 exposes the next near-term support level at 19,680/19,645. We also correspond to the lower limit of this minor descending channel that is in play since 21st of February high, and as well as this minor swing low area of 1st of October last year. Only a push up and an hourly close above 20,720 will invalidate today's intraday bearish bias to see a squeeze up to revisit 21,030. Above it potentially may see 21,330 coming in. We also confluence with the downward sloping 20 and the 50-day moving average on the Nasdaq 100. All right, so that sum up the intraday technical outlook on the major stock indices. Let us now focus on the commodities asset class, starting with gold XAU/USD. So for gold XAU/USD continues to trade sideways above our first support zone at 2090, 2,890 over here. So I don't want to tighten my short-term pivotal support to 2,890, still using 2,877 as my short-term pivotal support level. Still maintain the intraday bullish bias on gold XAU/USD, but it got to break out fast above 2,923 that has been acting as a resistance since this Tuesday. A breakout above 2,293 revisit the current all-time high level in first step at 2,954. Only a breakdown below 2,877 will invalidate today's intraday bullish biasness to kickstart another round of minor corrective decline sequence in first step, revisiting 2,845/2,834, which is the minor swing low area of 28th of February over here. Okay. So that's for gold XAU/USD. Lastly will be the West Texas crude oil. So the West Texas crude oil continues to stage a bounce off that medium-term pivotal support zone that I highlighted, and also right exactly at the boundary lower limit of this ongoing descending channel from the high of 16th of January. So still no change, looking for this potential minor corrective rebound phase to play out as long as 6770/40 medium-term pivotal support holds. First resistance to watch in this potential minor corrective rebound sequence, 6770. Above it potentially exposes 6880 on the intraday basis. Only a breakdown with an hourly close below 6740 will invalidate today's minor counter trend rebound scenario to revert back the bearish force for West Texas crude oil, exposing the next near-term support level in first step at 6480, followed by 6420/6410. All right, so that also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the calendar. What are the key data to look out for other than today's non-farm payroll, key US job market labor data? So today, Friday, so let us have a quick look at the European session what are the key data to look out for over here. So the European session over here, we do have two key ECB officials speaking. President Lagarde, more or less, she will repeat what she said yesterday at 5:30 p.m. Singapore time, 5:40 p.m. ECB Batch officials speaking, and thereafter you have a slew of GDP rate, Q4 GDP rate out from Eurozone. That shouldn't be a big surprise because there is a third estimate over here. That will be at 6 p.m. Singapore time. Then thereafter at 9:30 p.m. Singapore time, those who are actually focusing the dollar Canada and the Canada FX cross pair, we have a key Canada job data report out at 9:30 p.m. Singapore time. At the same time, we also see the release of that non-farm payroll data. Market is expecting a 160k jobs increase from 143k. Unemployment rate remains stable at 4% based on the current market expectation. So that'll be out at 9:30 p.m. Singapore time. And on top of this, other than this, we also have the boss, Fed Chair Powell speaking thereafter at 1:30 a.m. Singapore time. All right, so market potentially will be hearing his tonality on his view on the current macro environment, especially given the current fluid situation on Trump's trade tariffs policy. All right, and also heading towards the weekend on Sunday, that is the key China data inflation rate as well as PPI. So that will be released on this coming Sunday at 9:30 a.m. That could have a potential impact on next Monday, 10th of March, performance on the Hang Seng Index as well, potentially. All right, so that sum up today's daily dose of market insights. I'm Kelvin here, wishing you all a great day and a wonderful weekend ahead. And I also like to make an announcement that next week, the entire week, I will be off. So I will be off for the entire week from 10th of March all the way up to 14th of March. So between 10th of March and 14th of March, there will be no daily dose, and daily dose will resume only on the 17th of March at the same timing at 11 a.m. Singapore time. So with that, Kelvin here signing off. I wish you all a great day ahead, and we shall speak again on Monday, 17th of March. Thank you.